All right, so you're thinking about investing in the Midland, Texas area, or you think you want to invest in real estate here in Midland. Well, in this video, I'm going to be giving you my top 3 tips on what you need to know, because our area here in Midland is pretty unique. It's not like any other area around the United States. And so I'm going to be giving you my top 3 tips on what I think you should know whenever you're investing in the Midland area. All right, so the first thing you need to do as an investor is just you need to have a plan. You need to have a plan and you need to have your financing in order. Now, everybody right now, there are so many shows out there. Everybody's just looking to make some passive income. You know, the thing to do right now is to be buying real estate. It's all over TV. Everybody's doing it, but you want to make sure you have a plan whenever you are doing it. Now that you've made the decision that you want to purchase real estate, the first thing you need to do is you need to have a plan. What type of real estate do you want to invest in? What do you want to do? Do you want to do long-term rentals? Do you want to do short-term rentals? Do you want to do Airbnbs? That is the question that you need to answer. And so whenever you're coming in, you're starting out, you need to have a plan on what you want to do. And you also need to have your financing in order. Are you going to be purchasing cash? Are you going to be using hard money, private money, or a traditional lender whenever you purchase a home? And why are those things important? That's important because when a deal comes up, when a realtor brings you a deal, like myself, if I bring you a deal, it also depends on how that deal was acquired. So if I bring you a deal that's on the MLS and it is a situation where the seller possibly needs to close quickly, if you have cash, then we'll be able to close quickly and actually do that. If you've got a traditional lender, that might hold things up a little bit because there's going to be time. You're going to need appraisals, inspections, and termite inspections, and all of these contingencies in order to make a purchase. All right, so let's get to it. So now that you know that you want to invest in the Midland area, now let's get to what you actually need to know. I actually started my real estate career out as a real estate investor. When I separated from the military, I just knew that I wanted some residual income, some passive income, and so I started investing in real estate here in the Midland, Odessa area. I had 10 properties, all here in the area, so I know one or two things about acquiring properties, buying properties, renovating those properties, and then renting them out. And then we also help lots and lots of investors in the area here. And so the first thing that you need to know whenever you're going to be investing is you need to know exactly what you're looking for. What are your parameters? And so sometimes people will come to us and they'll say, hey, I want to buy real estate. And my first question is going to be, well, what exactly are you looking for? Because you need to know everybody has a certain type of property that they're looking to purchase. I know everybody just says they're looking for a good deal, but the fact of the matter is that you are looking for something specific. You might not be able to express that in the beginning, but that's going to be the first question that I'm going to ask you is, what are you actually looking for? What are your parameters? And so normally the rule of thumb, whenever we are evaluating deals, underwriting deals is what we call that. If there's a property that we're looking to purchase, we're going to take that property and we are going to figure out what the after repair value of that property is. Meaning, what is the value of that property going to be once we get done fixing it up? Or maybe we're actually going to purchase the property at market conditions. So that's why I say you need a plan. If you're buying properties, fixing them up, adding value, and then renting them out, that's one strategy. If you're just buying properties at market value, but you just want to be able to get a specific rate of return whenever you rent the property out, then that's a different strategy. And so those are the things that we're going to kind of need to know. So let's say you are going to purchase a property and remodel it in order to rent it out. Well, the thing we're going to do is we're going to find the after repair value, what that property is going to be worth after you fix it up. We're going to multiply that by 75 or 80%, and then we're going to subtract the repairs. So let's use a simple example here real quick. Let's say that we're going to purchase a house, and after we purchase that home, it's going to be worth $100,000. We're going to take 80% of that, which is going to be $80,000. And now let's say it's going to take $20,000 to fix that property up. Well, we're going to take that $20,000 from the $80,000, which is going to equal $60,000. That is going to be our purchase price for that property. So you're going to purchase the house, you're going to make an offer at $60,000. You're going to do all your repairs and everything. It's going to take you $20,000, and then after that, your value is going to be about $100,000. And then normally, a good rule of thumb for renting a property out is 1% of your purchase price is what you want to get in rent. And so if I buy a house and it's worth $100,000, then I want to be able to get at least $1,000 in rent for that home. And that's actually a pretty good investment. 10%, from your purchase price for what you're renting it for is going to be a really, really good value. Now let's say you don't want to fix the house up. You're just looking for properties on the market that you can purchase and immediately rent out. Then that's a little bit of a different strategy. So you find a house, it's $100,000, and you're like, okay, I found the house, $100,000, doesn't need any work, and I want to be able to rent it out for $1,000. That's the return that I want to be able to get, a 10% return. And so that's another strategy. So the main point here, though, is that you need to figure out what is your strategy. What exactly are you looking for? All right, number 2 on the list is going to be, where do you want to actually purchase your properties at? Everyone has a location that they want to be in. And where does this come in at? So what that means is there are some areas, normally we would classify areas as A class, B class, and C class properties, or even D class properties. Not a lot of people invest in D class properties. So A, B, and C class properties. Now, there are a lot of different factors that go into these different class of properties. So for instance, in an A class property, which is probably going to be in the higher echelon of price. Well, whenever you make a purchase in an A class property, you are more than likely going to have more appreciation in those areas, but your cash flow from those properties is probably going to be a little bit lower, right? So if you're purchasing a home that's $300,000, $400,000, $500,000 and you're looking to get rent for that, your cash flow on that property isn't going to be as high as it is on a lower priced home, but your appreciation on that property is usually going to be higher in those higher class properties. Now, as you go down to a B class and C class properties, you can usually get those properties at a lower price, and your cash flow is going to be a lot more. So before we talked about that 1%, you purchase a home for $100,000, you rent it out for $1,000, depending on if you've got debt service or not. Meaning if you have a loan on your property, then that's going to affect your cash flow. But in those lower tier homes, B, C class properties, you're going to have more cash flow. Usually in those areas, though, you do not have as much appreciation. And so with that being said, everybody's situation is different. And so whenever I was investing for cash flow. I wanted cash flow. I wanted the cash. I wanted to be able to take that cash and do other things with that whenever I got a check every week. But some people, they might not need the cash flow. They might want the appreciation. The other thing appreciation is good for is it's good for your net worth, right? So if you need a strategy where you need to increase your net worth, or your ability to borrow money or that sort of thing, then you might want to invest in some higher priced homes or A class properties. The other thing as well is if you're looking at short-term rentals, usually A class, B class properties, B plus class properties are a lot better for short-term Airbnb type rentals rather than B class, C class properties. So that goes into our last point, having a plan, knowing exactly what you want, and then knowing the area and location that you actually want to invest in, because that is going to affect your investment strategy. All right, and lastly comes the most important that I think is, and that is the actual price that you actually purchase your property for. Now, I know you've heard it said before, you make your money when you buy. Well, what does that actually mean? What that means is you get all of your equity whenever you purchase your home. So if a home is worth $100,000, sticking on our $100,000 example, if it's worth $100,000 and you buy the property at $80,000, then you've only got $20,000 of equity. But if you buy at $60,000, you've got $40,000 worth of equity. And you're not having to worry about the home appreciating in order for you to get your money back. And so you actually want to do that on the front end. You want to make your money when you buy, rather than trying to force a situation to happen whenever you're looking to either sell the property or exit the property or anything like that. Now, this is really, really important here in the Midland area. Why is that? It's really important because our economy here is really run off of the oil price, the price of oil, or whatever's going on with the energy sector at that time, or just around. And so if oil happens to go up or if oil happens to go down, having a better purchasing position, meaning buying at a better price, is going to help you. And this is one of the things that I took into account whenever I was investing myself, is that I had a certain amount of cushion that I wanted to have, because I knew, let's say the price of oil is $80 a barrel and then the price goes down to $45 a barrel. Well, if oil goes down, what's going to happen to housing here in Midland? The demand is going to go down. If demand goes down and supply stays the same, what happens to prices? Prices go down. So what that means is that rental rates are probably going to go down. And so if you buy at a good price, that is going to protect you for those fluctuations in the market. And that's also another important point, is that it's very volatile here in our area. The rental rates are really based off the oil price, and so with that going up and down, you could be really good one year and then have another year that's kind of lackluster, but at least you know that you've got enough cushion to cover that. So the worst thing that can happen to you is you buy a property, oil takes a hit, and then you're actually having to come out of pocket in order to pay for your investment. And so you want to make sure that you you actually purchase at a good price, so you've got that cushion on your cash flow. Talk to you later.